Hello and welcome to this Gartner webinar, IT Spending Forecast 4K24 Update, GenAI's Impact on a 7 trillion IT Market. This presentation will provide actionable objective insight, expert guidance, and solutions that enable faster, smarter decisions and stronger performance on your most critical priorities. I'm Akash, your moderator for this session, and before we get started, I have a few tips to help enhance your webinar experience. Around the video player, you'll find a variety of ways to interact with the session. We encourage you to participate by clicking the Ask the Speaker box to submit your questions and thoughts throughout this program. You can submit a question anonymously, or if you choose, your name, title, and company can be visible along with your question. To download a copy of the presentation slides and other helpful resources, just navigate to the bottom of the page. Throughout the program, you can read the session and share feedback on the insights provided. To submit your reading, locate the read session link below the player and a box will open for you to select 1 to 5 hearts. Please note that 5 hearts is the top rating and share your feedback on the insights provided in the Leave Further feedback box and click send. This webinar is being recorded and you can watch this presentation again and find more great insights on demand at gartner.com/webinars. Now, I'd like to welcome Gartner Distinguished VP Analyst Chief Forecaster, John Lovelock. John, thanks for joining us, and now I'll turn it over to you.
Thank you. What a great introduction. And good morning, good afternoon, good evening. Thank you for taking the time to be with us today. I'm going to be going through about 40 minutes worth of an update on our IT spending forecast. We're going to do a lot on generative AI. And as you've been prompted already, please feel free to put in your questions as they occur to you. Don't wait till the end. We'll answer them midstream if they apply. So let's get started. 2024 GDP growth starting to return to normal. In fact, the world is returning much more to a normal stance. We have inflation coming down around the world. We have interest rates coming down around the world. We have labor stabilizing around the world. Supply chains are getting back to more of a normal, predictable state. Not everything is back where it ought to be, but we don't see those short, sharp disruptions coming at the market. Now, there is certainly the new administration in the United States that is talking about tariffs, and that will have an impact on the market. It will cause some dynamism to be at play within North American IT market. But budgets are budgets. And by the end of the year, CIOs will have spent their money. They may be spending it with different people, but they will be spending about the same amount of money. I note across the top of this chart how many IT innovations we've had over the years, just how many things have come at the market, and recognizing that they are not always accompanied by any real change in GDP growth. Gen AI is, of course, the most recent. Agentic AI might be the next. But either way, we're looking at that technology being separate from gross domestic product, from productivity, from the ability of the world to create and consume things that are needed. But we do have a difference between the economic cycle that we're in and the technology cycle that we're in. From an economic point of view, we're in kind of a middle ground. We're neither facing headwinds nor do we have tailwinds. We don't have the economy enticing people to put money into their businesses, nor do we have those tailwinds saying, take money out, be conservative. On the technology side, we have swung into a very positive cycle. AI, Gen AI, the other components of the AI technology world have put technology back on the roadmap for boards, for CEOs, even for the CFOs that are out there. They are seeing technology as the solution to their current state of problems. Now, we've had a couple of years of cost control, of efficiency, optimization, CIOs being asked to work with department heads to bring internal value back to those organizations. That sort of middle lower ground of the economic cycle. But companies universally are turning back to revenue growth this year. They are seeing the economy as being in the middle, good enough for a planning foundation for them to build out. And the means by which they are building out is technology. What that means to everyone on the call is that you are going to be in a demand building environment where CIOs and department heads will not necessarily be seeking out you and your technology in order to solve their problems, but they will be very interested to hear from you on how you can help solve their problems. It is a sales led environment. Your competition this year is not just the people in your usual market. So if you're seeing PCs, tablets, software, ERP, SCM, CRM, whatever market you happen to be in, your competition this year is not only the usual folks that you compete against, but it's pretty much everyone up and down the stack. If you're giving advice on IT budgets and optimization, you have to recognize, well, this is actually the next slide up very well points out. Budget increases for next year are being absorbed by price increases. The expectations of CIOs going left to right, how much of their total budget have they set aside for their expected price increases on recurring expenditures that they can't get away from? So whether that's the hardware refresh cycle they're locked into, the software, the services, cloud licensing, contracting, outsourcing, the things they know they are going to spend on, how much of that price increase is going to be taken up from their budget? The median answer came back as 8.5%, with 5% of respondents saying 20% or more. Pretty much the entirety of their budget increase is going to what they believe are going to be price increases. From economic terms, that means nominal. Yes, we're going to see some very good increases in spending, but real terms, there are organizations that are only going to be improving their IT consumption by 1-2%. Some maybe even in the negatives. So when it comes to what's advice would I be giving the CIO on how to optimally budget for your IT, one, take budget or take price increases away from the burden of the CIOs. Allow for whatever price increases are out there to be absorbed by the organization, and allow CIOs to spend their increases on real terms, new technology that's needed. Because there is going to be a lot needed. $5.6 trillion US spending this year, 9.8% growth in US dollars, a little bit of a currency headwind at 8.2%. The US dollar is expected to lose a little bit of traction to both the euro and the Chinese currencies as well. The Japanese currency might be making some headway back this year. So some of the larger currencies starting to increase in value against the US dollar and bringing down that constant currency growth rate. When we look at where the spending are, it starts to tell the story of the difference of enterprise priorities, as well as where consumers are spending and where tech providers themselves are coming in. Software is in its usual position of high growth, 12.9%, but one of those industries is actually leading in concerns for those price increases. A couple of years back, software as a service companies notably started to raise their prices, and this is the year where we'll see most of that coming through from a CIO budget point of view. Data center systems surprisingly way out in front, 21.9%. Now, this is almost entirely down to the AI optimized servers that are being sold, and just how many of them are going into the technology service provider area. Companies, hyperscaler service providers, buying a tremendous amount of these. 76% growth overall last year, bringing up 20-something percent growth this year. We're starting to see the end of this rapid build out. We're starting to get to a more normalized thing in a couple of years where we'll see the run rates and the growth coming down. But servers, just a tremendous amount of spending, and we'll see a little bit more of that later. Overall, when we break out a little bit more of the spending, we get what we're used to in the way of markets in high growth rates, markets in some growth rates, and those that are hovering closer to decline. Infrastructure as a service, the basis of cloud, still growing at 23.5% growth this year, 23.6% for the next 5 years. This is a market that just seems to be unstoppable. It started in 2009 with 80% growth rates. It's come all the way down to 23% growth rates, but my goodness, what a market. Servers last year took off. This year, we're still seeing them growing extremely well. But you'll notice that the growth this year starts to become a little bit more in line with the long-term growth. 29.2% growth this year, 26.1% growth long-term. It is still a market split between the traditional CPU-based servers and the AI-optimized servers. The AI-optimized being the predominant reason for this growth, but the market being more of an add-on. It's not affecting negatively the CPU or traditional server growth. Software being the next largest growth market in there, all the markets that we're tracking in that 12% growth range, 12% growth long term. That's apps, infrastructure, and the vertical specific software all doing very well. Again, price increases driving some of this, but not sufficient to make up for everything. So we know we are getting net new logos coming in every year. We know we're getting expansion of functionality driving some of that price increase. We know we're getting expansion of seat growth every year. Now, interestingly, we're seeing on the other side of the things, fixed voice markets in decline, communication services universally not doing well, still growing, but not the growth market. PCs, tablets, mobile phones, both enterprises and consumers, still growing in that 5% range. Now, the increase in price on PCs and mobile phones are pushing a bit of a refresh rate this year. We know that Windows licensing has come over and is pushing a little bit more of the PC growth for us. So we have a surge this year of higher growth in those two markets, but long term, they're going to come back more to their norm. We see this shift between ownership to leasing, between having intellectual property and getting what is needed intermittently. So again, ownership to service being the bigger shift overall here. But if we start to look at Gen AI and saying, wow, this is a very dynamic market on its own. It is 5.6 trillion heading to 7 trillion. Gen AI is something that's still coming. 2024, the hype cycle had us right at our peak, right at the peak of inflated expectations. Now, Gartner is tracking many technologies within the AI hype cycle. But if we say Gen AI is sort of the center point here and their companion technologies, 2024, we started to fall off the peak. Now, again, the vertical axis here is expectations, not spending. It's not about interest. It's about what do I expect this technology will be able to do. And now we're saying we're on the wrong side of the peak. Our expectations for what are possible with AI technology is starting to come down. It was perhaps overly inflated. As Sam Altman has said, there's a lot of expectations on these models that are still currently not all that good. Now, the models are going to be getting better. We know the announcements coming out of the next versions from pretty much all of the large vendors are due this year. But the expectations from CIOs are going to continue to decline. And if we project this forward, 2025 is going to be the year of the slide, where we're going to see expectations coming down, even though service providers are bringing out new things. 2026 will be in the trough. And at this point, the CIOs will be taking the software that they bought and implemented in 2025 and stabilizing and trying to improve that software. By the time we get to 2027, we're coming out of the trough. Expectations now coming back up. The products have had 2 years of improvement. CIOs have had 2 years to get used to what Gen AI can and can't do, where it brings value and where it does not. And agent AI will start to push things along a little bit more. 2027, 2028, again, improving expectations. But spending isn't expectations. Spending goes up throughout this entire cycle. In 2023, we were at $82.6 billion. By the time we get to 2028, we're at $1.3 trillion out of $7 trillion of spending. It's a significant amount of the market, given that it doesn't play really in the communication services or the IT staffing areas, which are very large portions of that $7 trillion in spending. But when we break down the spending this year in 2025, $747 billion. But note how much of this is on hardware. This is a market that's actually inverted to our regular markets. In overall IT spending, hardware is about 20% of spend. Everything else makes up the remaining 80%. Currently, in generative AI, 80% of the market is on hardware, 20% is on those other things. AI smartphones making up the biggest component, PCs, servers coming along in third and second place, respectively. And then we blow out that light blue area, the everything else. That's when it starts to get to a normal spending pattern, where we see business consulting, AI models, application, infrastructure as a service focused on Gen AI, making up more regular ratios of the overall spending. So why are those? What are the CIOs going to be looking for from Gen AI this year, next year? And this becomes, unfortunately, a little unclear. We have so many opportunities for CIOs running into 2025. When we asked them recently about what outcomes are they expecting for their businesses, what are the top 3 outcomes that they're looking for, we got a pretty vanilla spread. Yes, operational efficiencies are there, increasing productivity is there, improved data management is there, overall revenue growth, but everything in that sort of 28 to 38% range. Nothing really has excited. There is no one thing that every organization is coalescing around to say Gen AI will bring revenue growth or Gen AI will bring the productivity that we've been seeking. Organizations are going at this with mixed outcomes, no consensus around what an outcome will be. There is no one message that you can use to sell your product or service that is a Gen AI feature in it. There is no one outcome that you can align with that is assured to be a priority amongst every organization. It does also mean that just about anything you say will resonate. It just might not be their top one, but again, their top priority doesn't seem to have an overwhelming consensus in the market. This is part of that expectation coming down. When we were at the peak of inflated expectations, organizations were much more clear. It was productivity and revenue growth. When we surveyed in 2022 and 2023, those were the 2 that came through most clearly. As we're coming into 2025, we've gone to homogenous because expectations are coming down. Organizations aren't clear what they can do, what it will do for them. They do know that they have money and that they will be doing things. And the smartphone market, again, the biggest part of this market. Everyone is going to own an AI-enabled smartphone. But they're going to be sold these phones. They won't necessarily be buying these phones. And that's a kind of a funny statement. We really do need to say more about it. What do I mean when I say sold, not bought? What the chart here is showing is how much money will be spent on these devices on the bar chart. The line chart is percentage of the devices in the market that represents. And for the powerful mobile phones, the premium mobile phones, the dark blue, by the time we get to 2026, 90% of the phones will have Gen AI feature function in them. They will have the NPU, the TPU, the extra chips needed to support generative AI and AI features running natively on the phone. And once we're at a market where it's 90%, you have to be, as a consumer or an enterprise, the purchaser of these, working pretty hard to find that remaining 10%. By 2027, they're all going to be this way. 2028, they will all be this way. You can't get out of the way of these phones. So with most consumer purchases, they're going to be going into stores and they're going to be asking for what's the best phone I can get within my budget. And they will be sold a generative AI enabled phone. They will be sold a generative AI enabled PC or tablet or laptop. They won't necessarily be going out and buying these because as of today, as for the next few years projected, There's no killer app. There is no must have application that requires these features to be on a phone. So while people will be happy to buy them as long as they fit within their budget, it's most of the phones, most of the catalog that's on offer. Enterprises will be doing a little bit of future proofing in their purchases. They will be happy to buy these. It will be a sales motion as opposed to a buying motion. They will not be going to market looking to get these features because they don't have a reason to have these features. They'll be happy to have them sold to them, but they won't necessarily be going out to buy them. Not the same motion within the AI optimized server market. Now, here we split the server market between dark blue, the traditional servers, light blue, the new AI optimized servers. And if we look just at the moment at the or the regular servers, the traditional CPU based servers on the bottom, they still have a good growth rate to them. Hyperscaler service providers and enterprises continue to buy CPU based servers to build out their infrastructure as a service, their hosting, and their data center capacity. Data centers are not going away. It's a story that we've been saying here at Gartner for the last 10 years. Data centers are still going to be an important part of enterprises' IT infrastructure. Our forecasts for the server CPUs reflect that. What is interesting is how much companies are willing to spend on AI optimized servers. Certainly, the purchase price of these is much higher. And as far as units go, they are still skewing towards the technology providers and the hyperscalers on the purchase. And by the time we get to 2028, service providers will be operating $1 trillion worth of AI optimized servers. Now, that's more than they have ever spent on CPU based servers. In fact, in 3 years, they're tripling their spend on servers just because of these AI optimized servers. The amount of money going into these things is staggering. The infrastructure as a service that they're running behind them is a little bit of a twisted story. We're seeing AI optimized still grow, or the infrastructure as a service still growing very well, 23.5 this year, 23.6 long term. The dark blue is the regular infrastructure as a service. The AI optimized infrastructure as a service is the light blue and the light green, where we split it between the CPU cycles and dollars earned based on training new models versus the light green, the dollars earned on inferencing existing models. Now, the inferencing to training, crosses over in 2028 or 2026. There'll be more money made training or inferencing than training. This year, last year, there's more money made on training, but relatively small percentage of this market actually being used for infrastructure as a service, or the infrastructure as a service running these AI optimized versions of it, not necessarily supporting that $1 trillion worth of computers. In fact, if we look at this as a year over year comparison, and we say, fine, the server spend is the dark blue, the money raised from infrastructure as a service is the light blue, the dark red or the orange band is the cumulative deficit. How much of a differential was there this year between the money earned through infrastructure as a service on AI optimized servers versus the amount of money we spent on AI optimized servers? Now, in any kind of new market, there would be a run up to say, I need to build out a certain amount of capacity before I can make money on it. I'm certainly going to spend a lot more on servers in year one than I'm going to earn on those servers in year one. And we would expect a deficit in the short term. What this is showing is by 2028, there will be an $852 billion deficit. Now, the world is saying, is there going to be an AI bubble? And this certainly does look like there is going to be a bubble. In one respect, where you could say the bubble is the stock market and what companies will be there, and if there will be a collapse, I can't speak to that. But is there going to be a collapse in the server market or in the infrastructure as a service market? I'm here to tell you that there won't be. That this gap is not, in fact, a gap. AI optimized servers are being purchased not to make revenue. the money being spent by service providers to generate the money that they are getting certainly has always been there, will be there. It's the light blue. The dark blue in this case is the internal value that they're going to get. Now, we are all used to and comfortable with the idea that AWS buys CPUs and rents them out as infrastructure as a service. We're all comfortable with the idea that some of the servers that AWS buys actually helps run internal processes, including Amazon.com. Google's infrastructure as a service helps support Google Search. Microsoft's Azure helps support all of the Microsoft software as a service in the Dynamics area that they run. So a portion of everything that the hyperscalers buy actually supports internal businesses. What we're saying is that the AI optimized servers are going to start providing more internal value than external. When we look at how the money is going to be split, we still have the idea of training and inferencing being sold, a $78 billion market by 2028. But the internal value expands to over $224 billion by 2028. Microsoft is running GPT in order to support Copilot. All the money that they're spending on those servers, the value is showing up in revenue for Copilot. Google is doing the same thing with Gemini. Meta is doing the same thing with Llama. XAI will be doing the same thing with Grok. It's training it and then they will inference it on their own servers. But what they are selling is the product, not renting servers. They are migrating from a business model where it's buy a server and rent the capacity. Now they are buying a server and they are becoming a product or service company. So the infrastructure as a service world, that cloud base that we are very used to and comfortable with, is not in fact going to be turned over to this AI optimized infrastructure as a service. Some, yes. There will always be the idea that we can, but the idea that the hyperscalers' core business model for doing this is going to be renting capacity is not true in the long term. They are going to become product and service companies within the Gen AI world. And why would they? Gen AI models themselves are growing tremendously. We can see the growth chart here. By the time we get to 2028, we're looking at a $39 billion market. Tremendous growth in the next few years as companies start moving over. Now, 2025, we start to see the emergence of specialized models. But for the next 2 years, this is a model that is, or a market that is firmly grounded in foundational models, the very largest of models coming through. Companies, software companies, other tech providers, and services companies are turning to foundational model providers to seek the feature functionality that they will build and bundle into their products and services. By the time we get to 2027, they will start to take, instead of these large foundational models that can answer every question, they will start turning to specialized models to help them with better functionality at a lower run rate. Large foundational models costs more to inference than a small specialized model. I don't need all the functionality of a foundational model to do cash flow analysis. I just need it to do cash flow analysis. I don't need a scone recipe. I don't need the Kardashian family tree. There's abilities within the foundational models that will always exist and will be there for consumers primarily, enterprises certainly, software and services companies that are looking for broader feature functionality, or the fact that anything can fit in certainly continues to grow. The model market does not decline, does not even show a hiccup in growth until 2027. It's the specialized models that start to grow after 2027. The incremental spending starts to become higher in the specialized models versus the foundational models in 2028. We expect that to grow a little bit faster from 2029 forward. Interestingly, this market does have a drain to it that we can't actually model, because this is a revenue-based model. How much money is turned over to the provider of the model for use of the model? And this works very well in a third-party arrangement where my company pays the model company in order to bundle it in with the software. I would pay $1, that's $1 into the model market. However, when I get around to creating my own model, any money that I make from using that model drains out of this market. If we look at Salesforce with Einstein as an example, Salesforce is making money within the CRM market, but they're not making any money in the generative AI market, and they're not making any money in the generative AI model market for Einstein. They're not charging their customers for that. They're charging them for the software. So when we look at the model market and how the competition elements roll out, the top line here is the business factors, the bottom line here is the technology factors, and the result is below. So if we are in a business market where value is attained only from the most advanced market or most advanced models, and we have this very prohibitive capital structure that keeps people out, we would end up with a monopoly market. If the costs and benefits are limited to high impact areas and new revenue generation, if the model complexity is dictated by capital, technical concerns, and high skill levels, we'll end up with a few vendors. And then as markets open up, we get closer to an open market and then, a fully open market. If we apply this model to what we know of foundational and specialized models, it's fairly clear that the foundational models are going to fall into an oligopoly. That costs and benefits will be limited to the high impact functions within an enterprise. That the complexity of these models is dictated by capital, technology, and the skills that are required. It will narrow down to a few vendors. Because as these models cost more and more to create, the market is not supporting them. $39 billion will not support models that cost up to $10 billion to create. But specialized models are cheaper to create, they're cheaper to run, they have more value, but they still, at least at the moment, have a high skill level to create. So we are not going to get to the very open market of everybody can create their own model. But we will get to markets where there are many specialized models in existence. They are owned by enterprises, software companies, and even the foundational model providers. But the foundational model providers will narrow down to an oligopoly of 2, 3, perhaps 5 vendors. And the spending that we see amongst the hyperscalers at the moment has the recognition that there will be a smaller number of these vendors at the end of the day. The software market, we've already seen first mover advantage claimed. What we're looking at on this chart is the amount of money being spent on software that has generative AI features, the dark blue, software without generative AI features in the dark blue, and software with generative AI features in it in the light blue. And by the time we get to 2026, 23 months away, there will be more money spent on software with generative AI features in it than software without generative AI features in it. The orange bars down at the bottom, that's representative of the actual amount of money that's being charged for software that's primarily about generative AI. So in our earlier example of Salesforce and Einstein, they are charging for CRM, but there's no meaningful uplift for using Einstein. So yes, light blue money, but no orange bar money. Microsoft is charging extra for Copilot. So the user fees that they have for that are included in the orange line and would be also included in the light blue. So in the email and authoring markets, tremendous amount of money in the light blue section. Other markets are taking longer. Vendors are coming into it with different products. They're offering up in different methods. They're either an add-on, a new platform that you have to do. It's tiered pricing, where you pay a premium or an extra charge. There's an extra uplift charge for seats, or consumption and token pricing for using the model. Now, all of those are buried in that orange bar. And see how little of the actual software market it becomes. By the time we get to 2028, it's actually reducing as a percentage and never gets above 5% of the overall software market being commanded by software that is foundationally Gen AI rather than the software that has Gen AI features in it. When we expand this out and we say market by market that Gartner is tracking, so at the macro market level, the first dot represents when we saw 5% of the market being attributable to software with Gen AI in it. And 2024, late 2024, for every market that we're tracking. By the time we get to 2026, 2027, it's table stakes. Over 50% of the spending in the market will be on software that includes generative AI features. And then for completeness, over 80% in the year that occurs. We have rapidly closing markets. Every software market already has first mover advantage taken, and companies now catching up. It also means this year in 2025, virtually every software company with every product that they are selling will have a Gen AI feature rolling out, either already there or rolling out this year, or early promises into 2026. It is a crowded, noisy market. From the CIO's point of view, it is a very difficult one for them. Remember, they're already facing price increases. Generative AI coming in as a price increase on existing software is part of that. It also means, from the CIO's point of view, that for every incumbent software vendor that they are dealing with, they're going to get a phone call this year, soon. We have generative AI added to the software that you're already using. You should be implementing us this year. Which means, from a CIO's point of view, they could be getting literally hundreds of phone calls trying to be sold generative AI. And their goal for the year has got to be, amongst all of the options that they have presented to them, which software is going to fit best in their corporation, which software or groups of software are going to bring them the biggest value, have the least risk in implementation, the least risk in production, where value amongst one or two or three vendors is more than the individual vendors themselves. They are going to be picking from a long list, not based on who has the best generative AI, but who brings the best complementary value to the corporation. So what you trying to sell software and trying to sell your wonderful new generative AI software, you are going to be competing with different competitors this year. Rather than just, I have supply chain software and I'm used to my competitors in the software or in the supply chain market, I am now competing for the CIO's time and attention and limited budget with every other software company proposing to have a generative AI solution. I can no longer sell just based on the fact that it is there or that it is the best generative AI solution. The criteria is going to be different. It's business value, risk, time, assurity, and these very soft, broad expectations for generative AI. So before we get to the Q&A, I'm going to wrap this up a little bit. There's 4 key takeaways from this. We have a tremendous amount of money going into Gen AI. We have a great deal of opportunity here. But first and foremost, the expectations for generative AI are going to continue to fall this year, but spending is going to increase. As products and services become available, CIOs will be buying them and implementing them. They will be shifting from moonshot projects where they're trying to develop their own projects, their own transformational, to trying to get in line with value that is being delivered from them. They will be spending on this. It is going to be a competition with the spending that they have for typical price rises. But again, some of that answer on we're expecting to spend more is because generative AI is coming. Gen AI products and services will compete for the CIO time and attention. This is fundamental. There are too many things, there are too many offerings coming at CIOs for them to have their own plan. It's not going to be about which are the ones that are possible to implement this year and I can afford to implement this year. It's going to be about which are the ones that I have the time and attention to implement, to make the corporate change, to bring value out, who meet my expectations for what Gen AI can do. Expectations falling. Nobody's talking about laying off all their employees anymore. Nobody is talking about doubling their revenue in the next 2 years. The expectations for what Gen AI can do have come down. We've already seen negative stories in the press around failures. We've seen companies that are early in the Gen AI storyline that are now starting to be acquired, starting to become conglomerates rather than point solutions. Gen AI will be sold, not bought. For many products, it's going to be about selling the CIO on your product rather than waiting for any kind of RFP or RFI to come through. Remember, we're still seeing most of the PCs, tablets, mobile phones having these feature functionalities included. And the people that are going to purchase them are not interested yet in these feature functionality because there's no application that requires them. So selling ahead of need is there. Same thing is possibly true for software services, outsourcing, where new features are going to come in, be made available, and then have to be sold to your incumbent. It also means, as a corollary to this, that the incumbent market, your current client base, is a likely more fertile ground for you for your generative AI features and functions than trying to grab net new logos. It also means that the competitive market is in a way that you no longer have an advantage simply by having a generative AI feature or function. The entire marketplace that you're in either has one or has one in the near term, close enough in the near term, that leveraging that to get a client to switch from a competitor to yourself is not going to be viable. And the final thought here is foundational Gen AI models will become an oligopoly. We're seeing the spending that indicates that the companies recognize this. We're seeing they are in a revenue at all costs. They are building out feature functionality, building out ecosystems, building out the partner networks that they have in order to be one of the few surviving foundational models within a few years. For those companies that are not building out the models but are looking to partner with somebody, it may be a year where you need to be very nimble. Committing to one partner has risk to it. Becoming too deep in one vendor also has risks in it. Being outside of any one of these vendors comes with risk to it. How do you solve your risk problem and ensure that you are going to be with a viable foundational model vendor in the near future? Do you need to switch to a specialized model for your feature functionality in order to entice your clients? These are all the bigger questions on how do you provide generative AI features that need to be solved in the next few years. Not necessarily today's problem, but you can't ignore it. And with that, I'm going to turn it back over and we'll get some questions loaded up. We'll go to the Q&A portion of today.
Thank you, John, for sharing your insights. And we have time to take some questions now. So please continue to submit your questions and thoughts in the Ask the Speaker box. And remember to rate the session. To submit your rating, locate the rate session link below the player, and a box will open for you to select 1 to 5 hearts. Please note that 5 hearts is the top rating, and share your feedback on the insights provided in the Leave Further feedback box and click send. Before we get to the Q&A, here are some resources to take you deeper into the topic. The Gartner Tech Growth and Innovation Conference 2025 is the premier event for technology solution providers. Visit the link to learn more about these and other upcoming Gartner conferences. Discover the key trends that will impact your business goals in 2025 and beyond. Download your copy of the Gartner Top 10 Strategic Technology Trends for 2025. Want to stay in the know? Connect with us on LinkedIn, X, formerly known as Twitter, and sign up to our bi weekly newsletter to receive the latest Gartner IT insights and updates across research, conferences, and more. If you want to learn more on how Gartner can help you achieve your mission critical priorities, contact us via the methods on this slide. You can download these resources from the bottom of the page. Plus, you can find more Gartner insights, access the presentation slides, and see upcoming and on demand webinars on gartner.com/webinars. Okay, John, over to you to address the questions.
Thank you. We got us back on the right slide. So I'll keep the overall spending slide up here as we go through some of our questions. And the first one is, will there be a golden cross between cloud technology and information center budgets in the near future? Well, depending on how you define the golden cross, it's likely already occurred. One of the interesting things about the software market is part of the fact that it is able to grow so quickly is that when we talk about cloud versus on-prem, I can buy cloud software for a certain amount of dollars. If I buy on-prem software, I also need server storage, networking equipment, and implementation services. So it's easier for me to spend a little bit more on cloud when I don't have that companion spending. It's built into the cloud offering. We have seen that shift for the last 15 years. In fact, my colleague Ed Anderson started to write about the cloud shift back in 2010. It's continuing. We're actually coming out with a vertical version of the cloud shift to show which industries are actually moving more quickly and still lagging behind on the cloud shift. How much of their work is being done on-prem versus in the cloud. So you can look forward to some of that research because, again, globally, we've definitely already crossed over between more money being spent on cloud than in the on-prem world. But there are many industries and many regions and countries where that's not true. So the timing of the cross becomes a little bit more interesting. We also have a lot of spending that is neither on prem nor in the cloud. Anything that would be communication services would be neither on prem or cloud. Anything that would be a PC, tablet, mobile phone might not be considered either cloud or on prem. But where there is a direct substitution between do I choose something that I own and operate on my own, or where I move it into the cloud and therefore become a service, we're certainly well past the idea of more money being spent in that service environment and ownership becoming less dollars. With that said, we are still seeing growth in the on prem world. More money is spent every year on servers to support the on prem environment. More money is spent on networking equipment, on uh, storage solutions. More money is being spent on licensed software year over year in many categories, not in all. So while the cross has been there and net new spending does skew towards cloud, on prem is not becoming less important on its own. It is just becoming less important when compared to cloud and other options. What foundational technology skills related to Gen AI will remain relevant regardless of the evolving trends? And this is a great question because Gen AI is still in relatively early days as far as the technology goes. We are seeing great leaps coming out on what is possible to do within multimodal large language models, agentic AI coming in. Always the most relevant skills are being able to translate a business requirement into a technology offering. The higher level skills are always going to be there regardless of where the generative AI, other option technology takes us. Agentic AI will work wonderfully. The question always becomes, where does business value come from? Certainly, we're always at the stage of if I can do what I'm doing currently a little faster, a little better, a little cheaper, that's always bringing goodness. And certainly the early adoption of any technology tends to be around, paving the go paths. Can I do something I'm already doing a little bit better? We get better leaps when we find out ways to do things that we ought to be doing that we have not yet been doing. And transformational when we come up with something completely different that can be done to get the same outcome in a different way that is better, faster, cheaper, higher quality, less risk, easier on the environment, or safer. So the transformation is always where we are looking for Gen AI to go, where we are always looking for new technologies to go. Where it always starts is in the incrementalism, doing what we're already doing a little bit better. And do you anticipate 20% spending on other than hardware spending to increase going forward, which can be in favor of AI and other large language engineers? The biggest spending in hardware is certainly around creating the capacity required for generative AI. and the other AI technologies that are out there. And I don't want to group in and say AI, Gen AI. We know that there are many different versions of AI technology. Generative AI is one of them. It's the one getting the most press right now, and it's certainly the one that we're focused on here for foundational spending. But please don't interpret the fact that I'm thinking that none of the other AI technologies are valid or important. The capacity build out is a requirement. We need a tremendous amount of these servers doing a tremendous amount of workload shifting in order to train the models that we will use and inference the ones that exist. Uh, the switch over between training models and inferencing models happens in the next 18 months or so. Depending on the market, the country, the region, the industry, the date's a little bit different. But within the next 18 months, we're going to go from creating models to more intensely using them. We still need the capacity to do that. We don't have enterprises using generative AI features anywhere near the levels that they will be using them in the next 4 or 5 years. So there's still a tremendous amount of capacity build out, both in server, storage, networking equipment, communication services to run them all through, the implementation and services organizations that are needed to do it, and the long-term managed services, make sure that all of this runs smoothly once it's in production. We are nowhere near the end of that road. The current is still on building out the foundation. Do I have the capacity? Do I have the data centers? Are they in the right locations in order to support the end user inferencing that will be happening and the intermittent training of the Gen AI models that are there? I have a question on the M&A landscape in the tech. Yes, this year, next year is going to be a pretty good year for mergers and acquisitions. It's going to be the switch over from the early startups in the AI world who had one piece of the puzzle starting to come together to form a company with many other. It is a natural evolution of the technology world. As a new technology comes out, we have many different startups getting different pieces of the puzzle. We have CIOs needing to do large consortia of companies in order to implement one solution. They can sometimes need multiple consultancies to help, multiple software companies to help. Different hardware technologies are required. And it's up to the CIO to piece together all of the companies required in order to get to a solution that delivers business value. The natural evolution is for this to get easier for the CIO, where companies actually start to bind together and say, there are 4 of us required for this one piece of software, we should be one company. There are 4 of us required, we can do this together. It eventually gets to the commoditized state where IT services companies are able to do the consortia behind the scenes, and the CIO only engages with the services company in order to get to a commoditized product. We're quite a few years from that hitting Gen AI. The other reason we're expecting this year and next year to be good years for M&A in the AI space is we're starting to run out of the cheap money that came out of 2020, 2021, 2022, when interest rates were very low, investment was very high. The last 2 years, we've seen improvements in the interest rates. Well, I guess interest rates have gone up. I won't say whether that's an improvement or not. Inflation has come down, which is nice, but interest rates have been up. So the money that investment companies are interested in getting a return on has gone up. The number of dollars that they've put into these startup companies has gone down. It also means that the startup companies that were there and that were comfortable with a high burn rate based on the ease of raising money in 2021, 2022 are no longer in that environment and need to get used to raising money in this new higher requirement area. We're going to see those companies, some of them, stumbling, and their way out will be to be acquired. The technology is good. What they have done could be excellent. Their ability to continue with their burn rate and their ability to raise capital is going to be problematic. So certainly a lot more in the way of M&A, given that overall environment that we're in. A great question here. What's the motivation to pay for Gen AI given lower expectations? I guess it's a difference between lower and low. If I was expecting that Gen AI in the past was going to allow me to double my revenue and fire all of my employees, I'd be very happy to spend a lot of money on it. If my lower expectation is 150% revenue growth and just 80 my employees, I'm still willing to pay for that. Lower does not mean low, it means less than it once was. And that's the trajectory that we're on. We will be at our lowest, still fairly high, but our lowest expectations for Gen AI sometime in 2026. That does mean a shift. If my expectations are very high, I'm willing to do the self development work. I'm willing to do the transformational work. I will willingly create my own generative AI models and spend them potentially millions or hundreds of millions of dollars to do so if my expectations are high enough. And certainly we saw lots of that self development work happening in the end of 2023 and most of the way through 2024. There were many projects that went on. Sometimes the money was not as good as people were hoping, but there still was a lot of work trying to test the idea of these very high expectations. Now, most of that self development work had a higher failure rate than people were used to achieving, and many of these projects either ended or concluded without going forward. 2025 is different in that I am no longer looking to be in this self development world. We've passed the stage of first mover advantage in software. CIOs are going to be able to purchase off the shelf software that includes generative AI in it. They're going to be able to move forward with their generative AI expectations with software that has a little bit more in the way of assurance around price, implementation time, value derived, and risk. So while expectations are coming down, spending is going to be going up because the reliability and predictability of the products that can be purchased and implemented continues to go up. Uh, and I have one last question here on on-prem versus cloud. Does data exist with trends? Which type of workloads are moving into infrastructure as a service? Certainly, software as a service vendors continue to be one of the larger users of infrastructure as a service. We had seen CIOs doing, straight lift and shift of self-developed work on-prem, traditional licensed. As that excitement of getting into the cloud and getting a little bit more reassurance around price stability, reliability, uptime was there. The price increases that we saw that CIOs started to feel back in 2022, 2023 started to limit the number of lift and shift implementations where Gartner would say that the value might not be there, that the price to actually run and operate in the cloud is higher than being on-prem where you have, good utilization or predictability. So while we don't see a slowdown in infrastructure as a service spending or the growth of that market, there may be a slowdown or deferral in some of the work, that early work around lift and shift that may have been less than cloud optimal, and more scrutiny of work that will get translated into cloud operations. And with that, I guess we're out of time. Ash, can you close us out?
Thank you, John. And before you go, just a quick reminder that you can download the presentation slides and other resources from the bottom of the page. And please read the session and share your feedback on the insights provided. To submit your reading, click Read Session link below the player and a box will open for you to select 1 to 5 hearts. Please note that 5 hearts is the top rating and share your feedback on the insights provided in the Leave for the Feedback box and click Send. Alright, with that, I'd like to again thank our presenter and of course, thank you all